I'm just going to do a screen share here. So thanks so much for joining us today. And so the topic for today are conditional offers hindering your business. And it's just after 11:30. The webinar is going to go for about 10 to 15 minutes. You'll want to hang in there at the end because I'm actually going to go through a real life example for an offer on a property that I worked with in conjunction with a local realtor. So, hopefully we'll get you out of here. I'm just checking the time at about 20 to 12, and you can go ahead and have your lunch. So some of the common questions you might be getting from clients, and certainly we get those questions, is, if I don't have cash, how can I put an offer on a property without a financing condition? And that's kind of the ultimate question that we're going to answer today. So we want to make sure that very few people actually have the 500 or 100, like 500,000, 800,000, $1 million, $1.5 million to actually put a cash offer on a property. So when someone is going to put an offer on a property without a financing condition or a conditionless offer, there's a lot more due diligence that's required by the mortgage broker, the company that's providing the financing, and the realtor, right? Because very few people do actually have cash for that. And then what I'm also hearing, so I am getting many requests from people who have gone to their bank, or they might be thinking about porting their mortgage and gone to their existing lender, and their lender says, we require a financing condition, like no questions asked. So that's where I'm getting a lot of clients contact us, buyers, because their realtors are saying, hey, if you want this house, you got to go in without conditions. So one of the things that we do in conjunction with the realtor is we review those the offer, and we'll also help borrowers understand what the risks are. And then the borrowers can make the decision whether or not they want to go in without any conditions or what the conditions should be. Okay, so when can a buyer go in firm on a purchase? And I'm kind of going to bring in Mortgage Financing 101. You guys, I know, have all taken the course because everything that we do around mortgage financing is related to the 5 C's of credit. And this is the basic element of this. And if there is an issue with one of the 5 C's of credit, the borrower cannot go in without a financing condition. Right. So again, at the beginning part of the process, like we have hundreds of people that we pre-approve annually for mortgages. We go through the 5 C's of credit with them so that they understand sort of where they fit on the spectrum of being an A+ or an A- or a B or a D borrower. So that's one of the things that we will review with buyers. Most common issues with a conditionless offer, and you have to remember, we have had many clients who've gone in with conditionless offers, and we review ahead of time what some of the risks would be. And so when the borrower understands what the risks are, then they can make a good decision on whether or not they want a condition or whether or not they can go in, whether or not they feel comfortable going conditionless. Okay. I do want to remind you, though, last year we had the same sort of activity and we're seeing it again. And one of the things that was troubling last year is that the market shifted. So we had lots of people put in offers on properties and they were like, hey, no problem, I'll be able to sell my house quickly. And then the market shifted. And what happened was interest rates went up and then buyers retracted, right? And so what was going to be like a quick, easy sale turned out to be a not so quick and easy sale. And I did deal a lot with offers last year where the sellers couldn't sell their house and they put an offer on a purchase without a sale of home condition. Okay. And I feel like history is repeating itself. And the reason for that is the Federal Reserve just raised its overnight lending rate a few weeks ago. And the Bank of Canada is going to make another rate announcement in early June. Now, we don't know if they're going to raise interest rates, but we will probably see another rate increase with the overnight lending rate before the end of the year, because the Federal Reserve cannot keep up with raising interest rates and Canada not following suit, because that affects our currency. And I don't want to kind of get too far into the weeds on this. So you just want to be mindful that although it looks like, no problem, we're going to sell our house, we did have some unusual conditions last year where interest rates went up quite a bit. And we will likely see another increase with the Bank of Canada's overnight lending rate in the next, before the end of the year. And so we might see buyers retract, right? So that's it in a nutshell. But where we see some of the most common issues with a conditionless offer is related to the 5 C's of credit. I'm going to walk you through this. So the first one, obviously, is credit history. We do a credit check on all of our mortgage pre-approvals, and it's not just the credit, the Equifax FICO score. We have a direct line to Equifax. Sometimes there can be false positives, right? And so what is a good credit score? Most financial institutions now are looking at a minimum FICO score of 680. That has gone up versus a year ago, where the minimum credit history for prime lending was 600 or 620. Now, you can get an insured mortgage with a 600 or 620 credit score, but I have not seen that recently. And it's just because insurers are looking at credit history, not just the FICO score, because there can be a false positive. And the reason why there would be a false positive would be the credit history is fairly new, less than a year. Or maybe they've declared a bankruptcy and there's fresh, just a new credit history there, right? There are some really great programs for new to Canada, but those Canadians have to have been in Canada for less than 5 years, and we can use like rent receipts to confirm credit history and other utility bills if they don't have a long credit history in Canada. I do have also many clients who are buying properties in Canada and don't have an established credit history in Canada, but do have an established international credit history, specifically in the US. So many lenders are asking not only for their Canadian credit history, but their American credit history. And, sometimes if the borrowers don't disclose that they own a house in the US, and an international credit history is required, that will impact people's ability to buy a house because we have to bring in that information. Some of the other common issues with a conditionless offer is the down payment and how the borrowers are coming up with the down payment. There are typically fewer issues with conditionless offers if people have 35% down or more. Okay, and I'll explain why. So sorting out the down payment and where the down payment is coming from and who it's coming from is important, right? So we have many clients who are getting gifts or early inheritance, and that's okay. We just have to understand where that's coming from and how to document it. This is another common issue with a conditionless offer, and it's related to capacity and debt ratios. And you guys have learned all of this, is gross debt service ratio cannot be more than 39. Total debt service ratio cannot be more than 44 for prime lending. Okay. When borrowers have 20% down, there is some flexibility with the debt ratio, not the gross debt service ratio, but the total debt service ratio. And also we can look at alternative financing because debt ratios, what we found are off these days because of the stress test rate. So for example, if the best 5-year fixed rate right now is at 5%, borrowers have to qualify based on an interest rate of 7%, which lowers their borrowing ability. And we do work with some lenders like credit unions and alternative lenders that don't have the same requirements for debt ratios because they don't have stress test rates, but the rates are almost 1 to 1.5% higher. So we want to make sure we really understand the people's income. Character and job stability is another thing that comes up. And what I found is that some of the lenders that we work with are more flexible with job stability because they understand a lot more people are changing jobs all the time. So rarely do we see people that have a 3-year tenure in the same job. But let's just say if we have a teacher who's on long-term occasional and that he is not on a full-time uh, teaching contract, we can use a 2-year average income if they've done supply teaching or a long-term occasion. Okay. Whereas other banks or financial institutions don't have that ability. And then the last issue that can come up is related to the collateral and the property. So these are some of the things as I'm sort of coming to the example that I'm going to show you at the end. Um, these are some of the things that you want to make sure that your buyers have provided. And we certainly do an excellent job, but we will require letters of employment with matching pay stubs. Okay. And, I was just speaking to someone earlier today. One of the things that I've noticed just because of the overheated market is there is a lot more fraud happening. So sometimes we get letters of employment and matching pay stubs. But when we do the employment verification, the phone goes to a bogus number, or even the website doesn't quite match what we're seeing on the letters of employment and matching pay stub. So there's a lot more fraud happening. And what we're hearing from borrowers is like, why do we require all of this information? Like, we didn't have to provide this before. And this is particularly important to have this information ahead if your buyers want to go into a conditionless offer. So we want to make sure that the buyers are prepared. That requires a lot more due diligence on our end. We don't mind, that's what we do, but it also requires the broker and the realtor to work together. The lenders will call within a week of closing to confirm income. Okay, so we have had instances where people have changed jobs and forgot to tell us. But one of the things that we say is if you're going to make a job change, wait until after you get the keys on the house. And then one of the things that I'm starting to see too is we are just through the tax season for 2022. If you have clients who are self-employed and don't have their income taxes completed yet for 2022, or seem disorganized, or I often have brag about what they actually make, that's a red flag for you and for us to say that these buyers cannot go in with a conditionless offer. So I do get some pushback. It's very rare from self-employed people, but we want to make sure that the self-employed people have their 2021 taxes, 22 taxes done, I should say, because they are technically due at the end of April. I know you'll say, okay, well, not really until June. If you do have outstanding Revenue Canada income tax, Revenue Canada starts calculating at the interest based on the beginning of June. Okay. The other question you should be asking borrowers is when and how did you get pre-approved for a mortgage? There are so many online calculators out there and auto pre-approvals where I have encountered people who thought they were pre-approved or thought they were pre-approved by their bank, but in fact it was an auto valuation, an auto pre-approval. So in order for your buyers to go in without a financing condition, they are going to need to talk to a mortgage professional and provide those documents. I always appreciate an email introduction. I always say to our buyers, hey, would you mind doing an email introduction with the realtor that you're working with, just so we can kind of both get on the same page? And there's constantly changes to the pre-approval criteria or the stress test rate. So right now, interesting, we're seeing very good interest rates on 5-year fixed rate mortgages. So better than they have been in the last 3 months. So if you did have buyers pre-approved 3 months ago, they should get their pre-approval updated, because they probably qualify for a little bit more. And remember that pre-approval is good for 120 days. And then the other thing that we often get is we get a lot of questions from people who have been pre-approved, and what is the impact in changes that they're going to make. If they're on salaried employment, and even if they're in a probationary period with their new employer, we can still use their employment if they have a history in that profession. One of the most common things that we're seeing right now is in the tech sector, people are changing jobs. So let's just say they've worked in the tech sector for 2 years, and they just recently changed employment, and they're with a new employer, but they're on a probationary period. We can still typically use their new employment, but it's important to update us. And this is where I just wanted to wrap things up. Where I'm going to spend the next 5 minutes just to wrap up is, do you have, this is something that we can go through, is we ask the borrowers, let's work out a backup plan on a low, if an appraisal comes in low. Okay, so we do a great job at looking at those other C's of credit, which is, we talked about credit history, capital, down payment, capacity, debt ratio, and character. The one C of credit that we cannot sort of evaluate until there's an accepted offer is the collateral or the valuation on the property. And one of the things that I wanted to encourage you as a realtor is that mortgage verification is becoming more and a more important step, even as prices rise. First-time home buyers are impacted more, or people who are just on that cusp of having 20% down are impacted on low appraised values. As I said, normally if someone has 35% down or more, as long as they understand the risks of a low appraised value, then they can go in without a financing condition. And it's very rare to see a low appraised value. We find that it happens in about 5 to 10% of the buyers that we work with. And sometimes the value, sometimes the collateral or the appraisal is not the issue. Sometimes it's the condition of the property that's the issue. So what we're finding is a lot of people, just to get into the housing market, are buying properties where there's an issue with the condition. So if there's a MLS that says like handyman special, that's going to be a red flag. So how do we work with that kind of property? Because it might be good value, but there could be some issues with the property. So what I wanted to show you here is a real life scenario that I just worked on. And I'm not sure if Ryan Waller is on this webinar, but this is an offer that Ryan and I worked on. So it's for a property at 5 Hamel, and I can share this information with you because the transaction just completed. So the borrowers had about $225,000 available for the down payment, but they preferred to have 15% for rentals. And the purchase price was $903. Okay, so let's kind of go through some of these details, and this would really interest you. So what I always ask is that the realtor send us a copy of the MLS with the seller's name on it. And the reason for that is we can see the details about the property taxes, because the details and the debt ratios are impacted by the property taxes. We can also see some of the comments that are made here. So, like if there's handyman secret special here, we know what's happening. And again, these buyers wanted to put an offer on on the property without a financing condition. Sometimes in more rural areas, we might see a residential property, but it's zoned commercial. So that could be an issue. And that's why we always like to get the MLS with the seller's name on it. One of the things that we do, and for those of you who have worked with us, we pull a purview report. And now these reports cost us about $20 a report, but they actually really help with understanding what's happening. And for our clients, we're happy to pull these reports. And the information is generated through TerraNet, which is a land registry system. And it gives you some interesting information. And this is some proprietary software that we use. But what it's telling me here is that sort of the estimated value on the property, which is a bit of a red flag, is about 800,000, 797,000. And I don't, so this might scare people, but if you have this information, you know what we're dealing with, right? And we can have a really good conversation about, okay, what does what does this purview report say? So it's telling me that the report, the value would be somewhere between 740 and 855. But there's some interest, and I shared this with Ryan. So there's some interesting other information here, because sometimes these reports are not accurate. So it's giving me what the average price of a house is. And mind you, the accepted offer was at 903, the middle price. And then if you scroll down on these purview reports, they also present comparable properties, right? And so that's where myself and the realtor worked together. And the realtor said, well, you know what? These comparables don't make sense because of this, right? And you can see here that sometimes the information is not current. So what the realtor did, and I asked him to do, and this is something that you guys can work with us on, is I asked him just to do some backup legwork, because these borrowers wanted to go in with a conditionless offer. So we got the MLS with the seller's name. We do the purview report on the property, and then the realtor comes up with a CMA, comparative market analysis. And what it clearly shows on the CMA, now these are all pending, but we included this in when we submitted the property for purchase. And you can see here that really the 903, given what we're seeing in the market, should be a decent value on the property. Okay, so let's kind of dig deeper into this. Again, I want to kind of get into the weeds so you understand this. And I'm going to wrap up in the next few minutes. So these borrowers wanted to put a 15% down payment. And so the expected mortgage for them was about 767,000. So one of the things that we checked is, well, can these borrowers get approved for an insured mortgage? And they can. But let's just say the value came in at 798, which was the purview value, right? This is on the other, we're uber conservative. The maximum that the lender would give on this property is 94% loan to value, which is 848. And this is okay then, because it's higher than what they were anticipating, okay? But what happened if these borrowers wanted to put 20% down to avoid the default insurance? Now, this is a more of a trickier proposition. So the purchase price was 903. If the borrowers wanted to put 20% down, they were looking at $180,000 down payment. So the expected mortgage was 722. However, if the borrowers wanted to avoid the default insurance and the appraised value came in less, the lender would only give 80% of whatever the appraised value is, or the purchase price was lower. So the maximum mortgage on this property was 638,400. So that means that these borrowers would have to put 264,000 as a down payment. And that's a big surprise if we don't talk about it. And again, the borrowers had about 225,000. So how do we fix this if the appraisal comes in low? Well, the first question is, do the borrowers qualify for an insured mortgage? And certainly they do. So, if they were expecting originally a mortgage of 767 and the appraised value came in low, they were at 96% loan to value. What they would need, because they originally wanted to put 135,000 down. In order to bring that down, loan to value down a little bit, they needed to come up with a little more than 35,000. And if they can't qualify for the default insured mortgage, for example, in this case, we knew they can, it could not go in without a financing condition. And so that was my message, is that in most cases, people can go in without a financing condition. In some cases, they absolutely can't because there's deficiency on the 5 Cs of credit. And maybe if the deficiency, for example, is related to the appraisal, then what we can do is we can, maybe you guys can put together an offer with the appraisal condition. So that wraps up our presentation for today. I did want to go into another criteria, another sort of, give me a second here. I did want to go into a scenario around like people having to sell your home, so an offer with a sale of home condition. But I think that's warranted for another topic. But one of the things that if you're putting a conditionless offer, you guys need to understand how bridge financing works. And if you're not sure about that, please schedule an appointment with me. And what happens if you're helping an out-of-town buyer who has he has another home to sell in another city? We also are finding that many buyers are deciding to keep their homes and converting them into a rental property. So that's an interesting proposition where you don't necessarily need to have a sale of home condition. And we are working with many seniors who want to downsize. And I'm not sure how many of you have attended our webinar in the past, but I did post that webinar on our YouTube page, the Mortgage Center Guelph, and you can actually use reverse mortgage for a purchase, and your sellers may not need to sell their home in order to move. So you can get them moved. So we've got a really great mortgage app. If you haven't already downloaded it, I would encourage you to do that. If you just go to our website at skipthebank.ca, on the top right-hand corner, you can download the app. You can run some amazing scenarios for your buyers. It also gives you real-time updates on mortgage interest rates. And I just wanted to say thank you for attending the webinar today. We are experienced and friendly mortgage professionals. You can always email me any questions. I'm pretty good with email. I usually get back in about 24 hours. If it's urgent, always call. And you can also schedule an appointment with myself if you go to my website at Skip the Bank. So I wanted to thank you for sharing your time with me today. And you guys have a nice afternoon. I am going to upload this webinar in the next few days to our YouTube site. So if you have friends who weren't able to attend, or maybe you might have some clients who are interested in seeing this, by all means, you could share it with them. Thanks so much and have a great day.